joining us today. We're going to give everyone about a minute or so, see who else is going to join us. We'll be with you shortly. All right, everybody, we're going to go ahead and get started. I just want to say welcome and thank you so much for joining us for part 2 of Biltmore Capital Advisors webinar on asset allocation. We're going to cover how we select individual assets. Today's webinar will be led by Dr. Donald R. Chambers, Biltmore Capital's Chief Investment Officer. Now, please feel free to type in any questions while the seminar is in session. And Dr. Chambers will try to answer as many questions as he can when the presentation is completed. So, Donald, I'm going to let you take it away.
Well, thank you. And thank you, everybody, for joining us today. Today, I have the pleasure of describing how Biltmore Capital Advisors selects individual assets within the model portfolios that we use for our clients. To provide context, I like to think of the decision about how to pick the assets for a portfolio as happening in 3 stages. This could be broken down or bigger, but a good idea here is to look at it in 3 pictures. One is the top-down decision, which is how much money do we put in stocks versus bonds or alternatives or cash. Then there's this middle area where we break it down a little further. So for instance, in the category of stocks, what percentage do you put in domestic stocks versus international stocks, and et cetera, and so forth. And then finally, the most bottom-up level is which individual assets or funds or securities do you pick for the portfolio. The previous seminar that we did, part 1, dealt with that top-down issue. This is going to deal with the middle issue and the bottom-up issue. I want to review very briefly the top-down issue. I'll make this brief. The seminar is available. The webinar is available. If you want to contact me or Tyler or Tim or Justin or Richard, we'd be happy to give you a link. I think the link was contained in some of the emails that went out before this, but it'll be good to look at after this webinar, even if you see this webinar first. So the top-down picture is basically the major asset classes that are in a portfolio, and it focuses on the investor's risk tolerance. It isn't an attempt to time markets or pick the hot assets. It's based upon matching the overall risk that a client bears to their preferences based upon their goals and their tolerance for risk and their financial situation. So it's the view that's presented in webinar, the first part of this webinar series, is to point out that bearing investment risk, it's unpleasant, but it's a necessary thing that we have to do in order to receive after-tax returns that are greater than inflation. So we don't want to bear risk, but we choose to bear risk because on average through time, that's the way that you can earn healthy returns in the long run. So there are different types of risk we could bear. If you look at the second bullet point here, the major risk that we like to bear is equity risk. Through time, that's what tends to have paid off the best. But we can bear other risks like interest rate risk, credit risk, skill-based risk, and there are a multitude of others. So our goal is to pick which risks we're going to bear, to spread, to diversify across those risks levels, and to make sure that the total risk of the portfolio is in line with the investor's goals and circumstances and risk tolerances. So with that behind us, suppose we have an investor that we think should be 60% exposed to equities. Well, the next question becomes, where do you allocate that 60%? And that's what we're going to talk about on 2 levels, the middle level and then the more detailed level. So the way that we're going to talk about these 2 levels, this is the middle level. It differs based upon whether we're allocating an equity a fixed income asset, or an alternative asset. So we're going to talk about each of those three things in order, and then we're finally going to talk about, once we've picked the subcategories, like in equities, we need to pick between domestic and foreign. When I say pick between them, it's allocate between them. We're going to use both. Large cap versus mid and small caps, growth versus value. Once we've decided how much are going to go into each of those categories, then we get into this bottom level, which is, okay, if we're going to be in domestic large cap value stocks, which fund should we pick? An active fund or a passive fund? Which structure should we use? And within that category, which exact fund should we use? That's where we're headed today, and we're going to do it in the order of fixed income, equities, and then alternatives, how we pick these subcategories. So let's talk about fixed income first. Given that we're going to allocate, let's say, 30% of a portfolio to fixed income, how do we pick which of all the bonds that exist out there we should be buying? And the first idea here at the top is we want to think about this risk bucket idea, these risk categories that we want to, this relates back to the first webinar, that we want to take some level of interest rate risk and we want to take some level of credit risk. And what we want to do is pick between the bond categories to take the appropriate level of total risk with regard to both of these types of risk. So for instance, if we put our money into treasuries, long-term treasuries, we take lots of interest rate risk, but we don't take hardly any credit risk or no credit risk at all. But if we invest in short-term corporates, we're taking very little interest rate risk, but in some cases we might be taking credit risk. Our view of interest rate risk at Biltmore is that it's primarily driven, of course, by the longevity or duration of the bonds that you invest in. And it's rewarded. Taking interest rate risk is rewarded, but it's not rewarded much for taking a lot of interest rate risk rather than a moderate amount of interest rate risk. So we'd like to keep our interest rate risk moderate. Credit risk has also received modest rewards. They're moderate, they're appropriate rewards. So we want to take appropriate levels of credit risk, but credit risk tends to have varying attractiveness based upon where we are in the credit cycle, of going from one credit crisis to the next. So the middle picture is that we want to allocate towards those fixed income classes that, when combined into a portfolio, are going to give us our target levels of interest rate risk and credit risk. We don't want to take too much risk. We want to spread out amongst the risk, but we need to take risks. If we put all of our money in money market securities, on an after-tax basis, we're not even going to keep up with inflation. So risk-bearing, as I talked about in our first seminar, is something that we do. It's something that we do to earn us a return. It's something that we do that contributes to a well-functioning society. So based upon where we think we are in a credit cycle and where we are in an interest rate cycle, for instance, we're now in a Fed tightening period. So recently we decided to put more money into senior bank loans and to underweight long-term corporate bonds. Those are the sort of decisions that we're making at this middle level of where to invest in fixed income. So when you look at the fixed income part of your portfolio and you see that sometimes we'll have more money in high yield, sometimes more money in corporate bonds, and we make these decisions to move, this is what we're trying to do. We're trying to manage the interest rate and credit risk of the fixed income portion of the portfolio to take the risks that are worth bearing, are being well rewarded, and to reduce the risks that we don't think are well rewarded. In the equities, maybe some of this will become a little bit more clear. Suppose a portfolio is going to be 60% equities. That would be pretty high. The first level of questions we need to ask after we come up with the top-down answer that we should put perhaps 60% of the portfolio in equities is, which region should those equities be in? Should they be in U.S., developed foreign funds, or small emerging markets? Also, the question is, what size stocks do we want to buy? Do we want to buy the huge stocks like GE and Apple, or mid caps, or small stocks, and do we want to emphasize growth or value? Now, it's important to realize that we're not jumping between these regions with huge bets. We're taking minor tilts relative to a very well diversified exposure. In the category of equities, the primary allocation method is to allocate to each area representative of the size that they exist in the market. So large cap stocks tend to dominate markets, especially the US stock market. So most of our clients' money is going to be placed into large stocks rather than mid caps or small caps. But given the idea that we allocate according to the size of a market in general, we don't do that with regard to international versus US. We put most of the equity money in the US market because of a variety of reasons. But given that we tend to allocate within the US market and other markets in proportion to the category size, so we put more money in large cap than small cap because large cap is a larger sector of the market, and that's a very good principle of diversification, is to invest in proportionate to the size of each market. So we follow that good prescription of emphasizing the larger markets, but we then place tilts. And when we say a tilt, what we mean is we make relatively minor adjustments to favor one category rather than another. So for instance, in the category of size, long-term evidence has indicated that small cap stocks tend to perform better than large cap stocks and mid cap stocks. So we put a slight tilt towards small cap stocks as a general principle. Now we may change that from time to time. In the style of growth versus value, growth being companies that seem to have most of their prospects ahead of them. Value companies are companies that are earning a lot of their profits right now. They might not have as much growth potential. We tend to favor value because, once again, long-term evidence and some reasonable theory suggests that value in the long run will outperform growth. So we alter these exposures with tilts based upon fundamental analysis and technical analysis. If we come down here, when we look at fundamental analysis, we use things like PE ratios. So on a quarterly basis, our investment committee is looking at the PE ratios through time of these different sectors and is deciding, is it time to take off a tilt or put on a tilt, because a PE ratio, in our opinion, viewed historically, is something that we can find where we might be able to get a higher return to risk ratio. We also use technical analysis with a mean reversion tilt. Now this is a really important point. I want to spend a few minutes on it because it can be frustrating to people when they don't understand what we're doing. We do look at history to inform us about the future, but we try to do the opposite of what a lot of people do. What a lot of people do is they chase recent performance. Now evidence indicates that that's actually a good strategy for short-run time intervals. In other words, an asset that's done well for the last 6 months is probably going to do well for the next 6 months. But when we start to get into periods of 2 to 5 years, when an asset class has done really well in the last 2 to 5 years, it's time to allocate away from that asset class. Now I'm picking 2 to 5 years. It's really not just the length of time, it's also the degree of movement, and this also varies between which asset classes we're talking about. But it may frustrate some people to look into our portfolio and see that we're in an asset class that hasn't done well in the last 2 to 5 years. Well, that's the reason that we're in that asset class, is because evidence indicates that when something has fallen out of disfavor for a period as long as 2 to 5 years, it probably has a better risk return opportunity than something that's been hot for 2 to 5 years. So that's how we do equities. Within alternatives, we can think of two types of alternatives. One is directional sorts of risks. These are alternatives that tend to move with the market, and then we look at non-directional or skill-based strategies, and we pick amongst these based mainly on managerial skill. We have a lot of assets in the area that we would claim to be alternatives, but we point out in this first note that when we talk about alternatives at Biltmore, we include real estate and oil and gas, master limited partnerships, MLPs in that category, and other people, and that's what a lot of people do. Some other asset managers don't include those as part of alternatives, and that's why sometimes our alternative allocation may appear a little larger than some others. So the next question is, once we've decided within a category, such as, let's say, equities, that we want to put in a allocation to, let's say, large cap value domestic equities. Once we've come up with that subcategory, now we're down to that third and most detailed level, the bottom up level. How do we pick the funds or the assets that are going to fill that category up? And first of all, our answer is we're going to use publicly traded investments in our model portfolios, and I believe in general we should focus almost all the time on publicly traded investments. By that we mean mutual funds, the ones that are registered with the SEC. They're daily priced, there's regular reports available, and exchange traded funds and closed-end funds that trade on the New York Stock Exchange. I've been a wealth manager for a long time now, and I have seen tremendous problems that occur when we get into private investments, and they can appear very attractive. They get marketed very heavily. There's tremendous fees to the people who sell them sometimes, but I believe that almost all of our investing should be done in publicly traded investment vehicles. So we start out with that as our idea. We're going to stick in our model portfolios entirely with publicly traded mutual investments. And we focus on funds. We're not picking individual stocks or individual bonds for our portfolios. We pick funds. Why? And the answer is we are tremendously diversified at Biltmore Capital. When you invest in one of our model portfolios, from conservative to moderate to all the way up to aggressive, there's 5 categories. You're getting thousands of underlying securities. And the reason that we have thousands of underlying securities is we want to be very, very well diversified. We don't want to take a risk that a particular stock like Enron is going to destroy a whole portfolio, or a bond of an Enron is going to destroy a whole portfolio. So we're incredibly well diversified across securities, and we as a firm can't possibly track and stay on top of 2,000 or 4,000 different securities. So we pick funds. Funds have an advantage that we can tap in many cases to the expertise of those managers, and we can get fantastic diversification. And in a lot of times we can get it with greater cost effectiveness than we could trade if we were doing it with our individual assets. If we trade individual assets, it can be pretty expensive to buy and sell a whole bunch of individual assets, where when it's done through these funds, we can get tremendous cost effectiveness. So I like to think about 2 categories that we invest in when we look for a fund. And in this first bullet point, in the most competitive markets, when we're investing in a major U.S. stock market or bond market, a Treasury market, we believe that those markets are so competitive that we tend to focus on managers who are passive index managers. What that means is that they simply buy a broad basket of those assets and they track that sector in general. They're not trying to beat the index. They're certainly trying to avoid falling short of that index, but they're just mimicking whatever happens in those markets. And when we're investing in that mode, and I'd say at least half of our assets are in that mode, we're searching for ultra low cost funds. And it's amazing nowadays that we can get funds that track these indexes and they have expense ratios of 10 basis points or less. That's 0.1% or less per year. That's so much more cost effective than we could do if we tried to manage those assets individually with the buying and selling involved. There's other markets that we don't think are as competitive, for instance, the bank loan market, or maybe in the small cap stock area, where we want to be more likely to consider searching for an actively managed fund. This would be a fund whose managers we believe have the expertise and skill to earn better risk-adjusted returns than the index. So when we look for an active manager, we're looking for somebody with a demonstrated track record, a good explanation for why their strategies work. This is called a potential for alpha, a potential for superior expected return. But of course, we still want to take into account their expense ratios. So we tend to go with asset managers who have demonstrated expertise. We use managers like AQR and BlackRock and Gabelli. When we can get expense ratio, we can get superior management with expense ratios that we think are reasonably priced. There's also the question of what structure that we use, whether we use exchange-traded funds or open-end funds or closed-end funds. And the answer is going to vary based upon, once again, this trade-off between the search for alpha, superior returns, and concerns about expense ratios and transaction fees. So when we look at a category like large cap growth, we're going to try to look for that structure, that vehicle that's going to give us the greatest return for our clients. And that in those cases, it might be some cases it might be an exchange traded fund. Occasionally it might be a regular mutual fund or an open-end fund. And other times it might be a closed-end fund. And the reason we would pick a closed-end fund is because, in our opinion, it has a large discount. Now, this is too complex of a topic for me to get into in this webinar. We have other material that covers this, and you're very welcome to contact me or Tyler or Tim or Justin or Richard and get more information about what we're doing in the area of closed-end funds. But in a big picture, I'll say this, that our exposure to closed-end funds is going to tend to vary through time. We're going to tend to get into closed-end funds more heavily when a particular sector or the market overall is stressed, distressed, it's gone down. And we're going to tend to be out of closed-end funds in very, very happy times, bull markets for the overall economy and for the individual funds. And the reason is because we're trying to get into the closed-end funds when they're at a large discount, and we're trying to get out of the closed-end funds when that discount has narrowed. So we've reviewed today how we take a general allocation, the top-down allocation discussed in webinar number 1, part 1, and we're going to try to turn that into a portfolio of individual assets. The way that we do that differs between how we handle bonds or fixed income, equities, and alternatives. And I gave a brief overview of that today. I want to emphasize, though, that throughout this process, there's absolutely no consideration of selecting assets that have a benefit to Biltmore rather than our clients. Now, that may seem like an unusual disclaimer, but I've been managing wealth for over 30 years, and the conflicts of interest in the industry are tremendous. And we're not, we do not have that conflict of interest. When I bring proposals to our investment committee and when we discuss them, there's absolutely no consideration given to an idea because of compensation of us getting by picking those particular assets, because we don't receive payments from the funds or anybody else for providing for selecting particular assets. I hope that I've tried to keep this relatively brief. I know it can be a little tedious sometimes to listen to too much. So I hope it's been detailed enough to at least give you a good idea of how we make some of these decisions. And right now, I'm finished, and I'd be happy to answer any questions.
Thank you so much, Dr. Chambers. We received a few questions during the webinar, and we'll go through these. And anyone, please feel free to send in any other questions you have. You're welcome to type it in the questions portion of your control panel there. So the first question we'll go over: how do you select between using exchange-traded funds and ordinary mutual funds?
Oh, that's a good question. I did spend some time on closed-end funds. Those aren't the ordinary mutual funds. I think by ordinary mutual funds, this question is asking about open-end mutual funds, the funds that Vanguard and Fidelity offer, versus the exchange-traded funds that they offer that trade on the New York Stock Exchange. And in both cases, what we're doing is we're trying to minimize the fees, the expense ratios. or maybe the client's taxes. Basically, we can get Vanguard or Fidelity or any other fund to manage it using either an exchange-traded platform or a regular mutual fund. And it's the same managers. They're doing the same thing in many, many cases, in most cases. So we're always trying to minimize the burden to our clients, the lowest expense ratios and the lowest tax burdens and the lowest transactions costs.
Okay, thank you. And the next question, do you select individual stocks along with the funds that you discussed?
No, in the model portfolios, which is what this is about, which is where most of our work is, in our model portfolios, we don't buy individual stocks and bonds. There are some exceptions that we make, but we leave that to our to the fund managers that we select because the markets are just too large for us. We do follow a few individual stocks like UPS and Exxon and others because some of our clients have concentrated positions in those assets. But in our model portfolios, we're not stock pickers, we're not bond pickers. We're picking other professionals to do that for us. And that's because we want to keep it so incredibly diversified.
Okay, perfect. And I see that a couple people have typed in some questions. There's one here that says, what is your view of international versus domestic equity markets? Do you like ETFs tied to MSCI index?
If you're going to be in foreign markets, then yes, an ETF tied to the Morgan Stanley index of international stocks is a great place to be. This is a very difficult issue. It's more of a part one issue. Well, no, it's perfectly valid here, and that is how much money should you put into domestic stocks and foreign stocks? And the theory tells us that you should base that answer on the size of those markets. And if we were to do that, you'd only put 30 to 40% of your equities in the U.S. and you'd put 60 to 70% of your equities in international stock funds. And I don't know hardly any Americans who do that. And this is called the home country bias. And it's very perplexing. It really begins to get into psychological terms as to why would we put, as Americans, put 60, 70, 80, or 90, some cases 100% of our money in just the U.S. market. I'm a resident of Florida now. I don't put all of my money only in Florida stocks. It would be ridiculous for me to buy only stocks that are in Florida. So why would I put most or all of my money in U.S. stocks? Well, it actually gets into psychology, and there's some valid reasons to do this. First of all, I tend to be very optimistic about the history and future of America and our support of innovation, and I think the U.S. is a great place to allocate assets to. But there's also just this thing called the home country bias where we feel more comfortable doing it. So I think international stocks are great, and it's a very difficult issue as to what percentage of our money should be in international stocks. And to your question, in terms of developed markets, we put our money in funds that tend to be linked to the MSCI World Index, but we also invest in undeveloped emerging market economies as well, and we have a fund that does that. That was a great question.
Okay, great. And the next question we have up is, they would like your thoughts on AQR managed futures fund performance. They realize that, it seems like we're waiting for a market crash and they want to see this fund perform well.
Well, be careful of what you wish for here. It was a very good question. Let me set the context for it. One of our alternative investment holdings, is a managed futures fund, and the manager that we've selected for that is, I think, the best in the world, is one of the biggest in the world, which is AQR, and that fund has not performed well lately. A major claim to managed futures, it's not the only claim, but a major claim is that it's going to be your protection, that when markets crash like they did in 2008, they're going to perform extraordinarily well. And we've been waiting now for 8 or 9 years, those of us, like many of us who are in that AQR fund, have been waiting that if the crash occurs, well, this is going to be like protection for us. And I think the question correctly raises the issue of, how long are we supposed to wait for this to happen? Well, first of all, I'd point out that the source of what we call the source of returns, the reason to invest in the AQR fund, or any managed futures funds, is not just in anticipation of a crash. The idea here is that there are imbalances in the world and of market supply and demand, and a good manager can get in on those and take advantage of trending or mean reversion in a way that makes sense even if a crash doesn't occur. But these assets, managed futures, have really underperformed in the last 2 to 5 years. And it's painful sometimes to stick with assets that have performed poorly for the last 2 to 5 years. And what we need to do is revisit why we're in those assets and why we believe they work. And protection against a crash is only one reason that we're in managed futures. The other reason that we're in managed futures is that if we looked at data for 100 or 200 years, we see that the way that they're trading has been successful over these very, very long periods of time. And when an asset category starts to underperform, whether it's this or value stocks, when they start to underperform, we tend to question it. And our emotions are going to make us do the absolute worst decision. I'll transition a little bit now to the growth versus value stocks. I've been a wealth manager for many, many years. And I remember in the late 1990s when growth stocks were so vastly outperforming value stocks that a lot of people finally gave up by the time that 1999 came, and they got out of the value stocks and they jumped on the bandwagon of growth stocks. And sure enough, what happened was that the growth stocks crashed. And they always do that. The growth has these great spurts. Growth stocks have been in a great growth spurt for the last 2 to 5 years. And that's why I'm not excited about growth stocks. I'm excited about what hasn't done well in the last 2 to 5 years. It's a contrarian view. It's a view that's very difficult to maintain emotionally, and that is to stick with an asset that underperforms for 2 to 5 years. And that's what I think good wealth management is about. Now, when I say this, I'm not talking about betting the farm or betting the ranch on this. I'm talking about tilts, that you're going to be in equities when value has vastly underperformed 2 to 5 years. It's a time to take a tilt towards value. When it's overperformed for 2 to 5 years, it's time to take that tilt off. I'm not sure we should ever be tilted towards growth stocks because of long-term evidence. But that was a great question, and it really gets to the heart of the issue of what wealth management is versus stock picking and what an awful lot of brokers and others do out there, which is they chase recent performance, they chase yield, and they get burnt. We're wealth managers. I've been doing this for over 30 years. I know how to manage long-term wealth, and it's frustrating to be in. It's a frustrating time to have some of your money in managed futures, but I still think there's solid reasons to be there. A great question, though. I appreciate it.
Thanks, Don. We're going to ask this next question and then a final one. So this next question is, what is your view of minimum volatile ETFs in today's market?
These are very good questions. There's this concept of investing called smart beta, and what it is that people find some category of picking stocks, a way to tilt a portfolio, and one of them is minimum volatility stocks. What you're doing is you're looking to overinvest in those stocks that have exhibited low volatility and to underinvest in those stocks that have exhibited high volatility. And this and others are called smart beta. We use a smart beta approach somewhat similar to this in our emerging markets. And the reason we do that in emerging markets is because we don't think that those markets are very well developed, obviously, and they're not very competitively priced. We think that these sort of strategies tend to work in markets for small stocks, in markets for emerging companies. We tend not to think that it works as well for those stocks or bonds that are trading in highly developed markets like the New York Stock Exchange. But there's all sorts of strategies like that, and I'm not trying to knock minimum vol, but we don't think it's as well diversified, and that it's better to, in the case of that particular potential anomaly, to be diversified rather than to tilt towards that particular anomaly. But It's not a bad idea.
Okay, thank you. And our last and final question, given that interest rates are going up from here, what bond funds would you recommend to invest for the next year or two?
Well, I'm reminded of something that Marty Zweig said years ago, which is never, ever, ever fight the Fed. And the Federal Reserve is on an interest rate tightening campaign. I happen to think that we're going to start to see some inflation coming back. And for that reason, and for the Fed tightening reason, we have shortened the interest rate risk exposure of our fixed income portfolios. And that sounds great, but remember, we get our returns by taking risk, and if we're not taking interest rate risk, we have to take other risks. So what we've done in our portfolios recently is we did a major rework of our fixed income portfolios about 3 or 4 months ago, and we shortened the interest rate risk, and we increased our credit risk. And we didn't increase our credit risk because we think it's the perfect time to take credit risk. We did so because we need to continue to take risks. It's a painful thing to do, but it's the only way to build long-term wealth, and I am a long-term wealth manager. So we increased our credit risk a little bit, and the best category to get higher credit risk and low interest rate risk is senior bank loans. They're very high in the bankruptcy liquidation process. So in some of our more aggressive portfolios especially, we've turned to senior bank loans. Some people call those levered loans, and that's if I were asked to pick a single fund in answer to this question, that's what I would pick. I would caution you, though, that in our model portfolios, we don't take tremendous overweighted positions in any asset class. So if you were to look at our model portfolios, you'd see that we still hold regular corporate bonds and in more conservative portfolios, treasuries and TIPS. So we certainly I don't want to come across here as being some sort of a cowboy who wants to put all their money in those senior bank loans, but I'm trying to be responsive to the question. Thank you.
Thank you so much. This concludes our webinar. We want to thank Dr. Chambers and all of our attendees today. We will be sending you an email with a link to watch this entire presentation, and we also welcome the opportunity to schedule a call with one of Biltmore Capital's specialists. Thank you.